So this is the syllabus content of Unit 4. Unit 5 will be later, okay? This is Unit 4 content, this is. Okay, so in this we have consolidated financial statement for a simple group with one subsidiary or one associate. And investment in associate, I moved it from Unit 2 to here, okay? In Unit 2, it is, if I've taken in Unit 2, it will not have a continuation. But here you'll be studying what is an associate and it will be very easy for you. And you'll be having computation of fair value of net assets, goodwill, non-controlling interest on date of acquisition, as well as a mix of Unit 4 and 5, as I said already. Okay, so let us start. So basic principle of consolidated financial statement position, consolidated statement of financial position, that is balance sheet, are mainly two. One is this consolidated financial position will show all the assets and liabilities of the parent and subsidiary. Before that, can someone tell me who is a parent and who is a subsidiary? On what basis?
Parent is a company who holds more than 50% of share of subsidiary company.
Okay, who holds more than 50% of its share in subsidiary company, that we call it as parent. Okay. So can a parent have more than one subsidiary? Is it possible?
Yes, ma'am. Why not?
Yes, ma'am.
Yes, it can have. Okay. So the first one is it shows all assets and liabilities of parent and subsidiary together. And who will prepare this?
Parent company.
Parent company. Okay. So the second principle is intra-group items are excluded. That is, any give and take between subsidiary and parent and subsidiary. Any transaction between them should be excluded. It is like head office and branch transaction, so we should not show it in the consolidated financial statement. A good example of that is receivables, payables, for example. If it is there and it includes the subsidiary and parent, means you should exclude it. You should not show it in your financial position. You have to exclude it. So these are the two basic principles. That is, all assets and liabilities of parents and subsidiary will be taken and shown in the financial position statement, and intra-group items are excluded. These two are the basic principle of consolidated financial statement. Coming to the mechanics of consolidation, these are the 5 workings. Actually, I can tell it as workings. These are the 5 things which you have to concentrate. Okay, so the marks will be allotted for each and every step. The first one is to establish the group structure. That is, how much is the parent holding in the subsidiary? What percentage? All such computation will be showing in the first point. Okay, that is very, very important, right? You have to find that first. Then only you can go for any proportionate allocation. So that is the first one. Second one is net assets of subsidiary. Okay, how much is the net asset of subsidiary or the net worth? Third one is the goodwill computation. It can be a positive or negative goodwill. We'll see later. Then fourth one is non-controlling interest. Okay, non-controlling interest is what? What do you mean by non-controlling interest? Yes. What do you mean by non-controlling interest?
Which parent company doesn't hold?
Which parent company doesn't hold? Yes. That is, the subsidiary is also a company. It will also issue shares. In that 50%, more than 50% will be held by the subsidiary. Let us assume 75% is held by the parent company in one company. So let us assume ABC and XYZ. ABC is a parent company and it is holding 75% in XYZ. So remaining 25% share who is holding? Some other shareholders. Collection of many number of shareholders will be there. So altogether, we'll call them as non-controlling interest. Okay. Other name, previously we used to call them as minority interest. Now we call them as non-controlling interest. Only the name differs. Okay. Then the next one is group retained earnings. So once these 4 steps are done, then only we will compute the group retained earnings. So let us see step by step. So the first step is establish the group structures. That is, how much of the subsidiary is owned by P. For example, P is parent, means how much of the subsidiary is owned by P and how long P has had control over S. Why this is important? Why how long is important?
Computation, ma'am.
For the computation, we'll be having pre-acquisition and post-acquisition. For example, in mid of the year, I acquired means, so before that, what is the profit? And after that, how much is after acquisition? What is the profit for that? And all I must know. So this, if I find what is a percentage held by the parent in the subsidiary, and if I know how many months or something, the exact number of months that it was held, okay, in the current year, it's very much very essential for me for the computation purpose. So this is the first step. The second step is net assets of subsidiary. We have some net assets. Actually, it is total assets minus current liability, or else your shares, that is equity. We call it as equity, no? So that part, both are called as net assets, but for computation purpose, we always take the equity component, that is share capital and reserves and surplus, that is share premium, retained earnings, revaluation surplus, whatever will come in other equity part, no, that part, that we will consider for net asset computation. So here we'll be having three columns. One is at the date of acquisition. For example, today I'm acquiring a company. On this date, what is the share value, how much premium I have, retained earnings, revaluation surplus, everything. And the next one is at the reporting date. Okay, for example, like let us assume my company's reporting date is March 31st. So today is 20th April, right? Oh, not April. So let us assume that my company's financial year is 30th June. So I'm acquiring in the month of April. Means, so on the month, in the month of April, on the date of acquisition, what is the value? I'll write in the first column. On 30th June, what is my value? I'll write in the second column, that is reporting date. And post acquisition. Post acquisition means from April till June end, what is the value, the in between value I'll be computing here. Okay, these are the three columns which I should be knowing about. So while doing the problem, you'll understand better. So coming to the note, if there is a post acquisition revaluation surplus, the group share of post acquisition revaluation would be part of the group revaluation surplus. Can you hear me?
Yes,
Hello?
ma'am.
Yes, ma'am.
Yes, actually, I was disconnected for a second. Okay. Is the screen visible? Is it shared?
Yes, ma'am. It is shared.
Yes, ma'am.
Okay. So here, that is if there is a post-acquisition revaluation surplus, that is after acquisition, that is from after April, if you have a revaluation surplus computed, the group share of post-acquisition revaluation would be part of group revaluation surplus and not taken to retained earnings. Okay, so we will be taking it to group revaluation only, and we will not take it to retained earnings. This also only if it comes in computation, you can understand very clearly. Okay, so let us go to the third one, the goodwill computation. What is goodwill first of all? What do you mean by goodwill? Leave this formula and all. You tell me what do you know about goodwill. Yes,
Intangible
Good
asset.
intangible asset, ma'am.
intangible asset. Okay. Then you have to value it in IAS 38. No,
Yes, ma'am.
will you value there in IAS 38 goodwill? In IAS 38, we will see only research and development expenses, patent, copyright, all such things are internally generated. We will not see. And goodwill will be considered only if it is at the time of acquisition of any companies. Then what does goodwill do at the time of acquisition? So in the context of acquisition, what do you mean by goodwill? Can anyone who have already appeared for FR, can you tell me about it? What happened? Those who have already appeared for FR exam in ACCA, can you tell me what is goodwill? Such a tough question. What happened? Let me point out someone attended 30-hour session, finished a consolidated financial statement. We are doing a kind of revision. What happened here? Hmm? Sound
Ma'am,
is not
whatever
there.
the
Yeah. You
whatever
are the
the
topper now this time.
whatever the
Tell me.
whatever
Yes.
the excess amount will be there. For the instance, now I am having a set of 1,000 rupees, but I'm paying 1,500 rupees. The excess 500 rupees, which can't be
Hmm.
apportioned to any particular asset. That is known as goodwill.
Very good. Very good. That is the company is worth, let us assume the company is worth how much you have acquired. Let us assume it is around 10 million or 25 million. But you are paying 30 million and acquiring it means the excess 5 million what you paid is for the good name or the benefit what you're going to reap out because of acquisition. So we call it as goodwill. Normally goodwill in one of the conference, one of the CA asked us, what do you mean by goodwill? So we were telling different explanation. He said, finally, no, it is just a balancing figure. He said very coolly. So that's the thing actually. It is the excess amount under which head you will put. You pay. Actually, the worth is 25 million only. You paid 30. 5 million, you cannot show it as profit because you are the purchaser here, right? You're paying extra. So it is something else. For the worth only we are paying. So we call it as goodwill. Okay. Then what is negative goodwill? Negative goodwill is what we never use this term, no? See, the same consolidated financial statement, BCom regular also have. Okay, but they will use the term called capital reserve. Okay, if it is a negative, they'll call it as capital reserve. But here we'll call it as negative goodwill. Just the term differs. Computation, everything is same. So what do you mean by this negative goodwill? How can a goodwill be negative?
Ma'am, sometimes the business doesn't work properly, so they give it to someone else. So in that order, for example, they're having a set of 1,000 rupees, but they're giving it only for 800 rupees. So that 200 rupees is our negative goodwill. We are purchasing something for less now than its actual
Okay.
value.
Yeah. How many of you go for shopping? I'm not speaking about the mall and posh area shopping. Going to Jayanagar, this one, Pathway and all, you'll be having small shops, right? So there, how many of you will go for shopping? Generally? So is it a very tough question? So have you ever done a bargaining so far? Or else whatever price they quote?
Oh, ma'am, many times I'll do bargaining only. Without bargaining, I don't buy.
You will do bargaining only in the people who will listen. No, you go and give enough money, more than enough money in jewelry shop without bargaining. Oh, okay, fine. So bargain is what? That is, you're trying to get it as a still more lesser price, or you feel that it's not worth that much. For example, I gave you a number like 25 million worth of company. I'm buying it for 30 million. That 5 million is a positive goodwill. If I'm buying it for 20 million, less than, that is 25 million worth of company, if I'm buying it for 20 million or 22 million, then it's my bargain purchase. It's my, I did a bargain, I bought it. So which we call it as negative goodwill. It has said, it will normally happen if the company is not that good in the performance for that reason. Okay. So, or the company is at the verge, what is it, at the verge of liquidation. For any such cases, we will buy it at a lesser price. Okay. This will be, see here, the working note numbers are there. So we'll come back whenever the working notes are there. So this goodwill computation will be, see, we'll see here, see the parent holding investment. Where can you find the holding investment amount? Where will you see this? In your balance sheet. P and S will be given in the balance sheet. Where can you find this investment? From where you will pick this value? Which side it will be there? This amount, parent holding investment and fair value it is given, no? That amount, where can I find it or where can I fetch it from my balance sheet? In the theoretical part, we discussed already, consolidated statements will be prepared based on the information which you get it from the separate entity. That is IAS 27. All the subsidiaries will prepare their individual financial statements. And from that only, we are going to prepare the consolidated financial statement. So individual financial statement, company X, company Y, like that, they will give you. So based on that only, you're going to consolidate. So this particular item of investment, which side you can find it, and in whose balance sheet column it will be available. Let us assume A is the parent and B is the subsidiary, or else P is the parent and S is the subsidiary. In whose balance sheet, which side this investment amount will be available?
Parent.
You guessing or answering?
Guessing.
Parent.
Guessing. See here, SOFP. Let us assume this is P, yes, and this is assets, and this is liability, P, S. Where will this investment appear? Where will this appear? First, whether liabilities or asset.
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 Okay. So it will appear in asset. Okay. Where it will appear?
Parent company.
Parent company, correct? So means to say parent had invested in subsidiary. Clear? And normally it will be mentioned as investment, sometimes investment in shares, investment in net assets, something they will mention. But this investment amount is exactly how much they have invested in the subsidiary will be mentioned here. So you have to pick this value from your asset side. The next is non-controlling interest at acquisition. Okay. For this, you have to go here. This working, okay? We'll be doing some workings here. So this non-controlling interest, we have two methods, that is fair value and proportion of net asset method. Any one method we'll be following. Okay, method one is fair value of non-controlling interest holding at acquisition. That is number of shares NCI. NCI means non-controlling interest. That is other than parent, whoever is holding the 80% shares are held by parent, means remaining 20% will be held by non-controlling interest. So this non-controlling interest, okay, how many number of shares they own into what is the share price of subsidiary, we'll multiply, that is our non-controlling interest if we are using fair value method. In case we are using proportion of net asset method, in that time we will do the NCI percentage. I said no, 20% into fair value of net asset at acquisition. You have to see working note 2. Okay. At the date of acquisition, what is the fair value? This total you have to take. Okay. Compute the non-controlling interest percentage. We'll solve it. You'll understand better. So this is the value, whichever method I'm going with, I'll be computing and I'll be taking it here. Okay. Then less fair value of net asset at acquisition. Working note 2. Okay. Fair value of net asset at acquisition. We'll do one problem and see. Then goodwill on acquisition. The difference is called goodwill on acquisition. If it is if there is any impairment, we have to subtract and we'll get the goodwill value. Okay. So this goodwill workings, we solve one problem, we will come to know better. So the next one is non-controlling interest. So non-controlling interest at acquisition, that is working note 3. Put the working notes properly here. Okay, fine. We'll solve some problem. We'll come back to this later. So non-controlling interest, where and all that, the acquisition, non-controlling interest value at acquisition, non-controlling interest of a share of post-acquisition reserves and surpluses, and share of impairment, if any. So all such things we will add. Where and all this NCI is there, you have to take separately and add it. And if there is a negative figure, you have to subtract, you'll get the non-controlling interest. Group retained earnings. Group retained earnings is you have to take the parents' retained earnings 100%, whatever is appearing in the equity, retained earnings you have to take. Then parents percentage of subsidiaries post acquisition retained. For example, post acquisition retained earnings is 50,000 or something, means what is the parent share that you have to take it here. And if there is any share of impairment of parent, that you have to deduct here. Subsidiaries impairment share we will deduct in non-controlling interest. Sorry, non-controlling interest impairment we will deduct in non-controlling. Parent share of impairment will deduct in group retained earnings. So we'll do a practice. This everything whatever we discussed, we'll do it here. Yeah. So this is test your understanding 1. So here what is given? 2 companies are there. Can you see this Excel, everybody?
Yes, ma'am.
Yes.
Yes, ma'am.
We have 2 companies, Dickens and Jones. So the following statement of financial position have been prepared at 31st December 2008. These are standalone, that is separately, standalone financial statement we call, or individual entity, that is separate in a separate financial statement. They have prepared. Dickens, they have prepared separately. Jones, they have prepared separately. Okay. Then what is given? Dickens acquired 16,000 ordinary $1 share in Jones on 1st Jan 2008, when Jones retained earnings stood 20,000 and its share premium was 10,000. On this date, the fair value of the 20% non-controlling shareholding in Jones was 12,500. The Dickens Group uses a fair value method to value the non-controlling interest. Prepare the consolidated statement of financial position. So I may use the pen sometimes. Sometimes I may use Excel. Only the group structure I'll be using pen. Okay, remaining everything I'll use Excel only. Okay, so let us see here. So what are the information given? Dickens acquired 16,000 ordinary shares. Oh, 1 minute. My pen is not working here. Just a minute. Roll number 39, you've raised your hand. Yes, roll number
Sorry,
39.
ma'am. Sorry, ma'am. Like when
Okay.
you asked about Jayanagar and all, I raised. Forgot to write it down.
Okay. Okay. Yes. Can you see the screen?
Yes, ma'am.
So what is step 1? What is step 1?
Group
we put it as-
proportion.
Yeah,
Group.
the pen is not working here. I don't know what happened. Okay, fine. I'll type it. No other option. So the first, sure. Okay, first workings. Okay, I'll put it as working. So in working note 1, the first one is group structure. Since I don't have the pen right now, it is not working. How in general they will draw. One more thing, those who have appeared for the exam, definitely you would have got one consolidated financial statement. Am I right? Yes, students, those who appeared for ACC exam, everybody would have got one consolidated financial statement problem, no? Complete silence. I don't know why it's like that. Yes. Yes, roll number. out. I find out. Because I know who and all appeared for the exam, but who appeared for FR, I cannot exactly remember. Yes. Did you get a consolidated financial statement? Am I audible?
Yes, ma'am.
Ma'am, you're
Then
audible.
those who appeared, what happened? Not speaking only. Still attendance is not claimed, no? Okay, fine. Just I just want to remind you, attendance is not yet claimed. People answer and confirm that you written the paper. Yes, some of you. Even answering. I don't want to ask the same person, that's why. Okay, Saurav, are you there in the meeting? Okay, fine. So can't help. So which are the companies we have here?
Two companies, Dickinson Jones.
And the another one is Jones. They normally write like this. Why I want to know is, I want to just find out how you people drew and show that. Whether you draw it or just show like how much is Dickens holding or how much is Jones. What option was given in the exam uh, the Excel spreadsheet? That's the reason I want to know. Okay, fine, no problem. We have no colors, means that. Okay. So Dickens acquires Jones. Fine. And how much he acquired? Any information is given here?
16,000 of ordinary share.
16,000 of ordinary shares. That is, how many shares does Jones have?
16,000.
How many shares Jones has?
Okay.
20.
20,000.
20,000. Can you see this? 20,000, $1 per share. So it is 20,000 number of shares. In this 20,000, 16,000 is acquired by Dickens. So what's the percentage?
Ma'am, 80%, ma'am.
It's equal. Will you find?
80%. 16,000 divided by 20,000 into 100, no, ma'am.
You hear me now? Yes. How will you find here? What's the
Ma'am,
percentage?
16,000.
16, 20,
16,000 divided by
100.
20, right? So I can convert here into percentage, which is 80%. So Dickens is holding 80% on Jones. When this acquisition is happening?
1st January.
1st Jan
1st Jan
2008. And what is the reporting date?
31st December.
So this acquisition started at the beginning of the year itself. Okay. So this happened on 1st Jan. This happened on 1st Jan 2008. So this is the group structure. I got to know 80%, and when it happened on 1st Jan, so the entire months, the complete year is post acquisition. What are the transactions we have? So let us go to the second workings. Second working is working note 2, which is net assets. Net assets of whom we'll find? Net assets of subsidiary. Who's the
Both,
subsidiary here? No, subsidiary. So it is net assets of Jones we'll find here. This is step 2. So all the problems, wherever it is required, we'll go with the steps so that, like in the revenue also we did the same. Later you'll become very comfortable in it. Okay. So net assets of Jones I'm going to find out. So here I'll put 3 columns. What is that? The first one?
At acquisition.
At
At
acquisition.
acquisition, at
At
reporting date, post acquisition.
post-tax. Three values I have here. So net assets, as I said, what do you have to check in net assets? Net asset is what?
Equities.
Actually, what is net asset? Two formulas are there, I told you.
Non-current asset plus current
Fair
asset.
value,
Something.
No, total
fair value.
assets minus current liability. Both will be same, but we are going to use only the equity one. So equity means what and all I'll be taking here. I'll be taking what is my share capital. I'll be taking what is the share capital. Then what else is given? Share premium. All these three I will take. So at the time of acquisition, so I'll just do like this. So at acquisition means it is on 1st Jan 2008. What is the value? Jones value. How will you find out? You have to read what are the information given here. See, it's given.
Adjustment, ma'am.
Yes, the paragraph it is given. Adjustment below the balance sheet it is given. Dickens acquired 16,000 ordinary share, $1 in Jones on 1st Jan when Jones retained earnings stood at 20,000. This is 20,000. This is 25,000. Why it is differing? What's the reason?
Because it's a post 25 is post acquisition, no ma'am. Because 31st
Year-end.
December.
Very simple. It's year-end balance. 25 is year-end balance. In the beginning, it's 20,000 only. So the acquisition is happening at the beginning. So what is the share capital? Share capital remains the same. So it is 20,000. And share premium also 10,000. At the time of acquisition, retained earnings alone, it was 20,000. It seems that given here. Okay, they've given the information here. Share premium is 10,000 only they've given. So the share premium and share capital remains the same. No change in that. But retained earnings alone, it was 25. It is 25,000 now, but it was 20,000 at the time of acquisition. Okay. Then what at the reporting date? What is the reporting date?
31st December
So whatever
2018.
value given here, that is year end. Exactly, I'm going to copy paste this. That is 20,000. Let's copy paste. What will be post acquisition then?
The difference of acquisition and reporting.
Exactly. If I keep this as A and A minus B. It's for your understanding. Don't put A, B, C and all. It's only for your understanding, nothing else. This is A minus B acquisition. So how much is actually B minus A post acquisition? It should be acquisition reporting date. Yeah, B minus A. What's the difference here?
0.
This minus this. Value which I have. Okay. Now I'm going to sum it up. Add. Okay. I'm going to sum it up, and this is the value which I'm going to assets of subsidiary. Doubt in the net asset working to computation? Any doubt here?
Ma'am, why are we not
No, ma'am.
taking 16 and what do you say? The adjustment values, ma'am.
What I
For
didn't get
at acquisition. For at acquisition,
you.
why are we not taking $16,000 for
See, we are computing new net assets of Jones only. They are not asking about how much Dickens acquired and all. They are asking what is the value of share capital, premium and retained earnings of Jones. Then everywhere you have to compute percentage if that's the case. You're just
Okay.
taking it. What is the value of Jones? Okay. So let us go to the next one. Working note 3, our favorite goodwill. we are going to compute goodwill here. So coming to goodwill, we have that format, right? Let me write the format here so that we can later on take it. So first we'll be having parent holding. So parent holding is the investment. There you can find this. Okay, I'll come back later. Let me write it first. Okay, parent holding, then non-control. This will be given normally. Let's leave one line because I add this, how much I'll be getting, I'll be writing in this line. And then from this I have, and they said very clearly, this they are computing based on fair value method. Fair value of it. That's what we are going to take it. So let me take what is the parent holding first. And again, in the beginning itself, you can write all the amounts are in dollar. Don't necessary innovation. So we'll put dollars here. That's it. Not in millions. If with millions are there, I'll normally take 3 zeros out. This is only in thousands. So let me take it out. Okay. So parent holding in investment. Where can I find it?
Balance
Parent.
sheet, ma'am, investment in shares in zones.
Very good. In the balance sheet, here it is there. Investments, shares in Jones. How much it is? 60,000. So this 60,000 is the investment which company made on it? That is Dickens made on Jones. 60,000 they've invested on Jones. What is the non-controlling interest at acquisition? Yes.
12,500.
Yes, it is given in this problem. On this date, can you see this paragraph here? Third line. On this date, the fair value of the 20% of non-controlling interest. That is 20% because 80% is held by Dickens means obviously 20% will be held by non-controlling interest. No? So that value, the fair value of the 20% non-controlling shareholding in Jones was 12,500. So parents' investment is 60,000. And other than parent, whoever third party, their investment is 12,500. So this is the worth of the company. Okay, 72,500. Okay, how much is the fair value of net asset at acquisition? Fair value of net asset at acquisition. 60,000 is a
50,000.
parent's investment. Yeah, which you will see. Which column actually?
First column at acquisition.
First column you will see. So I can put here as working note 2. Yes, 50,000. Okay, so now find out what value of net asset of Jones. Net assets, fair values, Jones worth is 50,000 only. How much is the investment made there? But Jones fair value, that is Jones net worth is only 50,000, but we have made 72,500 as investment there. So what is this? This is called as goodwill. If you write also, it's fine. You understand this goodwill computation?
Yes, ma'am. Yes, ma'am.
Yes, this format repeats. It will repeat. That's it. This format again and again, 2-3 times. If you write no fourth time onwards on your own, your hand will write without your control. Be very Now working note 4. Working note 4 is non-controlling interest. It does not have a continuation. So non-controlling interest. So non-controlling interest, when we come to non-controlling interest, just a minute, I'll show you the workings also. Okay, PPT is not shared. Okay, see the PPT here. This is the fourth point. Non-controlling interest, that is non-controlling interest value at acquisition, non-controlling interest share of post-acquisition reserves, and we don't have any information about impairment. So this two we are going to take. Non-controlling interest at acquisition, non-controlling interest share of post-acquisition reserve. Okay. So let me write it. Non-controlling interest at acquisition, non-controlling interest I have non-controlling interest, I'm going to pick it. So non-controlling interest at acquisition, how much it is?
12,500.
Yes, it is given, no? So we are going to write 12,500. Then non-controlling interest share of post-acquisition profit. Where is post-acquisition profit? Where it is given?
Working note 2.
Working note 2, how much it is? 5,000, right? This is 5,000. Is this entire 5,000 belongs to non-controlling interest?
No, ma'am, 20%.
20%, right? So 5,000 into 20% belongs to non-control. 5,000. Okay, both are positive figures because it's a profit, and so this is also a profit is equal to sum of this 13,500. This 13,500 is the non-controlling interest value. Right? Fourth workings, and the last working is my retained earnings workings. Okay, the fifth working. So let me show that once. See here, group retained earnings. Group,
Ma'am,
when we speak about
the
it is
post
about,
acquisition NCI,
I didn't get you.
post acquisition NCI.
It's wrong somewhere.
No, I'm asking, can you repeat that?
Oh, this one. Okay. See, this non-current asset share of post-acquisition reserve. This part you have about 1,000.
Yeah, 500 into 20.
Yeah.
5,000.
See, you got it.
No, that's what I'm asking, ma'am.
Okay. 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 See, this 5,000 is post-acquisition profit, which we computed in the net assets. That is from the time of acquisition till the reporting date. How much is the value? 5,000 is the value, and that 5,000 belongs to both the shareholders. That is holding company, not holding, parent as well as non-controlling interest have share in this. Since parent is having 80% share, 4,000 rupees, $4,000 will go to parent, and the remaining 1,000 will go to non-controlling interest.
Yeah, okay. Thank you.
So with this working, I'll stop. That is working note 5. Coming to group retained earnings. So here, if you see, it is P's retained earnings. P means in our case, it is Dickens. Okay, Dickens retained earnings 100% you have to take it because this is a computation of the group. So a P's retained earning you have to take. That is Dickens retained earnings 100% you have to take. Then Dickens share of post-acquisition retained earnings. So just now I was telling to Nishita, the 4,000 no, we will take here. And we don't have any impairment in this problem, so forget about it. So I'm going to take Dickens percentage Jones. Only the terminology different, remaining all are same. Coming to retained earnings, where can you find this value? Where it is given?
Balance sheet.
In the balance sheet, how much it is given?
70,000.
20,000. Okay. 70,000. Dickens retained earnings is 70,000. That is the column of Dickens you have to see, and its retained earnings 70,000. Then Dickens percentage in Jones post-acquisition profit. So that is the 5,000 which we computed, right? That one into 80%. Correct? No, 80% is held by the parent. So it's 5,000, 4,000. 4,000 is the share here. So we don't have any impact of this two. Okay, so this is the value which we got in group retained earning. So we got everything, just consolidation we have to do. Do you have CBCS class today?
Yes, ma'am.
You have it at?
2.
Okay, so another 2 minutes. I'll finish this now. It won't take more than 2 minutes. Consolidated financial statement is very easy, just addition. Otherwise, again, repetition will happen. Just bear with me. I'll finish this. So working notes are over. Now I'm going to solve the solution. I'm doing the solution. Consolidated financial statement. Only financial position. End of the year, that is 31st December. Going to prepare this. So 2 columns you can have if you want to, otherwise 1 column is more than enough. For assets, 1 column is enough most of the time. Liabilities, you need more. So let me put the first column. I'm going to start with non-current assets. Leave some space. Randomly just leave some space. We don't know how much non-current assets we have here. So only 2 items are there. Only 1 item, property, plant and equipment is there, and current asset is there. So you can randomly leave three or 4 lines, and then you can start with equity. Coming to equity, what are the equity part I have here? So I have ordinary shares, premium, retained earnings, and I may have one more. So the same what I typed here, I'll copy paste. Capital, share premium, retained earnings, one more, that is non-controlling interest will come here. Okay. Then I have current liabilities. Put CL, you write current liability properly. So let me take one after the other. What is the basic principle of consolidation? First principle, it shows all assets and liabilities of the parent and subsidiaries. They didn't mention equity here. They said only assets and liabilities. Can you understand?
Yes,
Yes.
ma'am.
Yes.
So assets and liabilities you're going to combine and show. So first non-current assets, I have PPE. You have to write plant property. How it is given, you have to write as such. So property, plant and equipment. So I'll write here as PPE, and how much it is, I'll just add both the values. How much is both the values? 85,000 plus 18,000. Dickens 85 and Jones 18,000. So I will
103
just, yeah,
1 lakh.
85, 18,000.
But we are supposed to prepare for Dickens only, ma'am.
Dickens will prepare. Okay, Dickens will prepare it, but now after acquisition, everything belongs to them only.
80% belongs to him.
Correct. That's why we are computing non-controlling interest separately.
We'll subtract here in the financial statement.
Financial statement. Okay, you just listen first. So PPE we have to take. Then the next item is investment. You should not take this investment because that only we split here already. So that how much you invested and how much is the goodwill, everything we split and we'll be showing it separately. This investment of 60,000 you're not supposed to take. And next you'll take current assets. Current asset is 160 plus 84. Thousand plus 84,000. Okay, 2,44,000. Then what else? Then we'll go to the first we'll post whatever is there in the balance sheet, then we'll come back. Okay, so non-current asset is done. Investment we are not supposed to take because we have already split into goodwill and investment. We already found goodwill and also we are not going to take. So what is goodwill? This 22,500. We have to where it will go. Goodwill. Positive goodwill. Where it will go.
Non-current assets.
Non-current assets. Better always write goodwill first. Okay, then you can write PPE. How much is goodwill? Goodwill is equal to 22,500. When investment is coming into picture, immediately go and see what is missed out because we are not going to take investment, right? So I finished my asset side. Coming to the liability side. Liabilities means they said only the liabilities will be added. They didn't speak anything about the equity. Equity, what will I do? What will I take here? Whose equity I should take?
Parents.
Parents only. Okay, parents equity only will be taking here. That is 65,000. So I'll just write in the inner column. 65,000 means to say how much is the share. It is prepared by the parent company. Subsidiaries and all will prepare their individual financial statement, but consolidation will be done by the parent only. So their capital only we should take 65,000 we will take. How much is the share premium? Don't add it here. How much will be the share premium?
35.
5,000. Okay. And how much is the retained earnings?
Group
Which you will
retained
take?
earnings.
Group retained earnings,
will-
74.
Correct. 74,000 group retained. Please, you have to take it here. Okay. Then I said one more thing. Group, when we speak about non-controlling interest also, you should not miss it. How much is the non-controlling interest value?
13,500.
30,000.
So yes, I got it from working note. Retained earnings. Non-controlling interest working note is 13,500. Right? Then coming to current liability. So this I'll write it here. Is equal. So once this is done, it will be easy for me to recollect in the class. Half means it's very, very difficult. Current liability, all the assets and liabilities. See here, basic principle, all assets and liabilities of the parent of subsidiary will be taken. Intra-group items will be excluded. And when it comes to equity, the parent will be taken and retained earnings, only group retained earnings will be taken. This will come in practice. So coming to current liability, what is the value which you will add it? So what is given there? That is 1,35,000 plus 7,000. We'll add and we'll take. So problem should tally as usual. So done with the consolidated financial statement, the first step is over. That is first type of problem we have done from TYU. So one more, we'll do it in the next class, TYU 2. Then we'll go to the exam kit problems. Okay, small problems we'll finish and then we'll go on to the final one. Okay. So any doubt in this you can ask, or else we can discuss it in the next class.
Ma'am, you said you will say something regarding NSET.